Welcome to the deep dive. You know, there's just something about gold, isn't there? It has this almost timeless appeal.
Absolutely. A symbol of wealth, stability.
Yeah,
Especially when things feel a bit shaky.
exactly. A store of value. But the tricky part really is taking that feeling, that appeal, and turning it into smart investment moves in today's markets. It's just overwhelming sometimes.
It really is. There's so much information coming at you constantly. News, reports, charts, social media.
Trying to sift through it all, figure out what actually matters, what's a real signal versus just background noise. You can end up just spinning your wheels.
That's a really common problem. You see people reacting to every little blip, every headline, and like our source material points out, that can actually cost you time and money.
Right. You end up making moves based on, I don't know, fear or excitement, not really a solid plan.
Exactly. Which is why this deep dive, hopefully, can act as a bit of a guide through that noise.
Precisely. So today we're diving deep into Newmont, ticker NEM.NYS. I mean, they're a giant in the gold mining world.
One of the biggest players, yeah.
But we're not just looking at their numbers in isolation. We're going to unpack this really interesting framework called the VPA rhythm trading strategy. It's supposed to be a way to, cut through that market complexity we were just talking about, find the key moments, the turning points.
And what's really compelling about this VPA approach, I think, is how it tries to pull different threads together. It's not just looking at the financials or just the technical charts.
Okay.
It actually integrates those with things like order flow, even social sentiment, trying to get a more holistic view. Almost like seeing the market's choreography.
Choreography, I like that. A roadmap for navigating a stock like Newmont, focusing on timing.
Right. A proactive approach, not just reactive.
So our mission here, for you listening, is to pull out the really important stuff from all the sources we have. We've got Newmont's detailed financials, analyst notes, technical deep dives, even what people are saying online.
It's a pretty comprehensive set of materials.
Yeah, we want to give you a shortcut, basically.
Yeah.
Help you get properly informed about Newmont without getting bogged down. Understand not just what happened, but why it matters, and how this VPAR method helps interpret it all.
And like you said, the sources cover a lot of ground. Financials, market commentary, technical analysis, social media. It's all in there. Now, the original material mentions a sort of foundational report on VPR itself, but for this deep dive, we're really focusing on applying those VPR ideas directly to Newmont, using the details we have in front of us.
Got it. So a practical application.
Yeah.
Okay, let's pivot a bit then. Talk about the bigger picture, the context for Newmont's recent success. Gold prices.
Yeah, you really can't talk about Newmont without talking about the price of gold. It's been on an absolute tear.
Our sources say, get this, a 41% year-over-year increase, reaching $3,320 an ounce. That's massive.
It's extraordinary. I mean, that kind of jump completely changes the game for a gold miner. It's a huge tailwind pushing them forward.
So more than just a little bump.
Oh, absolutely. Think about it. Every single ounce they dig up is suddenly worth 41% more than last year. Their mining costs, well, they don't jump 41%.
Right, those costs are more fixed, relatively speaking.
Exactly. So a much bigger chunk of that extra revenue flows straight down to the bottom line. It boosts their profit margins dramatically. It's not just good, it's like a profitability supercharger.
A tsunami of profitability, as you put it before we started. And it looks like Newmont really rode that wave in Q2 2025. Their results look pretty strong.
They certainly did. Very robust financials. Q2 revenue came in at $5.3 billion. That's up 21% year over year.
Okay, 21% growth. That's solid, especially on top of that gold price surge. Shows they're executing.
Definitely. And it gets better when you look at earnings. Their adjusted EPS, earnings per share, hit $1.43. The market was expecting something closer to $1.16.
Wow, so a significant beat versus expectations.
It's a substantial beat, yeah. Even the GAAP EPS, which is often more conservative, was strong at $1.23. When a company beats earnings by that much, the market pays attention.
What does that signal, really, beyond just good numbers?
It signals efficiency. It says, yes, gold prices are helping, but the company's also managing its operations and costs really well to translate that higher revenue into even higher profit than analysts thought possible. Strong cost control, good execution.
And the market liked it.
Oh, yeah. The shares popped 4.8% right after the announcement, hitting $64.45. That's immediate positive feedback.
And there was another figure, $1.86 billion in incremental gold revenue, just in the first half of 2025.
Right. That's the extra revenue they got purely from gold sales compared to before.
Hmm.
It highlights both their production levels holding up and, crucially, that amplified benefit from the higher gold price per ounce.
So they're producing and selling into this strong market. Makes sense.
It shows they're capitalizing effectively. And alongside that operational strength, they made some interesting financial moves too. Strategic ones. They announced a new share buyback program.
Buybacks. Always interesting. How big?
$3 billion? That's a serious commitment.
$3 billion. Wow. And are they actually doing it or just announcing?
They're doing it. Our sources say $1.36 billion has already been executed just this year, so they're actively buying back shares.
Okay, so what does a big buyback like that actually tell investors? Why should you care?
Well, several things. First, it screams strong cash flow. They've got the money to do it easily.
All right.
Second, it's a huge vote of confidence from management. They're basically saying, we think our own stock is the best place to put this cash right now. It's undervalued.
Right. They'd rather buy their own shares than maybe start a new project or just sit on the cash.
Exactly. And third, it's a direct way to return capital to shareholders. It reduces the total number of shares out there, so each remaining share represents a bigger slice of the pie, which usually boosts earnings per share and can lift the stock price.
Plus, they cut their debt too, right?
Yeah. Disciplined spending helped them reduce net debt down to $7.5 billion. That strengthens the balance sheet, cuts risk, gives them more options down the road. It's just solid financial management all around.
Okay, so Newmont's looking pretty healthy financially, riding this gold wave effectively. Now, let's bring back this VPA rhythm trading strategy. How does that help us make sense of all this? You said it's not about reacting to every headline.
Right. The core idea, the philosophy behind VPAR, is to avoid getting whipsawed by the daily noise. Our source material actually warns that reacting to everything can erode both capital and time.
Okay, so it's about being more selective.
Precisely. It aims to identify the overall flow timing, the bigger underlying rhythm of the market for that specific stock. And then you only react to really key news or events when the stock is at a major support level, what they call a pivot.
Finding the market's rhythm, like a dance, you said. Being patient, strategic.
Exactly. It's trying to find those high probability moments, the real turning points, instead of chasing every small move. It's built on patience and precision, aiming for the bigger swings.
So how does it actually do that? What are the components? You mentioned chart patterns.
Yeah, chart rhythm patterns are key. It involves looking for specific repeating patterns on the price charts. These act like visual clues about market behavior and the underlying trend.
Like shapes or formations on the chart.
Kind of. Sequences of highs and lows, candlestick patterns, things that suggest a particular market psychology or flow. It's like reading the music score of the market.
Okay, but charts can be subjective, right? How do you know if a pattern is real?
That's where the next piece comes in, and it's critical. Order flow analysis. VPR insists you combine the chart patterns with analyzing the actual buying and selling pressure.
What does that mean, order flow?
It means looking at the volume of trades, the size of the buy and sell orders hitting the market, who's doing the buying and selling. Are big institutions stepping in, or is it just small retail trades? It confirms the conviction behind the pattern.
So you see a pattern, then you check if there's real money, real conviction backing it up.
Exactly. It helps you tell if a pattern is likely to hold or if it's just noise. It's about verifying the visual with the actual flow of capital.
Makes sense. And the goal of combining the chart rhythms, the order flow, is to find
optimal entry points, pinpointing the best moments to get into a position, ideally minimizing your initial risk and setting you up for the potential larger move identified by the rhythm. Surgical precision, like you said earlier.
Okay. And how does this help with managing risk day to day?
Well, it encourages looking at multiple layers. You monitor the broader sector gold mining trends and the individual stock, Newmont, seeing how they fit together.
Context is key.
Right. And the source mentions tracking live indicators during streams, suggesting a real-time element, constantly adjusting based on what the market is doing now, always aiming to manage that risk while looking for those higher returns.
You mentioned pivots before. Major support pivot levels. Tell me more about those. They sound important for this strategy.
They're absolutely central. It really begs the question, doesn't it? In this flood of information, how useful is a system that filters noise and focuses only on these critical turning points?
Yeah, what makes a pivot different from just regular support?
In VPAR terms, a pivot isn't just a level where price might bounce. It's seen as a critical juncture, an inflection point, where the market could be signaling a major long-term trend change.
A fundamental shift.
Potentially. Think of it as where the market's underlying rhythm changes its beat significantly, starting a whole new upward or downward cycle. It's often where market psychology hits an extreme, leading to a structural shift that could last months, even years. Finding these pivots accurately is what VPR is all about.
Okay. So applying that to Newmont right now, the stock's around $65.75, and the analysis says it's digesting its midterm box range. Unpack digesting in box range for us.
Right, financial jargon, let's break it down. Digesting just means a period of consolidation or sideways trading. It usually happens after a big move up or down. The market's pausing, absorbing the news, letting buyers and sellers find a new equilibrium.
Like catching its breath.
Exactly. And the box range is the defined channel it's trading within during this digestion phase. There's a clear support level below the floor and a resistance level above the ceiling, and the price is bouncing between them.
Okay, so it's consolidating gains basically within this defined range, and the analysis flags a specific zone, $50 to $60, as potentially very important.
Hugely important. The insight is that if Newmont were to drop back into that $50, $60 area next year, it could signal a major long-term trend reversal. It's identified as a potential strategic pivot into a new upward cycle.
So not just a dip to buy, but potentially the turning point for the next big long-term move up.
That's the implication. For long-term investors, a level like that is critical. It's where you'd expect serious buying interest, not just quick traders, but larger patient money to step in. If it holds, it could mark a significant low before a new, sustained uptrend. VPAR flags it as a high probability point where the rhythm might shift decisively upward.
Wow. Okay, so it really is like having a treasure map then, with specific spots marked X. And the VPR analysis apparently gives very specific entry points based on different time frames: short-term, swing, midterm.
Yeah, the investment opinion section in our sources gets really detailed. It lays out specific buy targets for those different horizons. But, and this is crucial, they aren't just price levels. Each one requires a specific set of conditions to be met first, according to the VPI method.
It's not just buy at X price.
Definitely not. It's about the timing, the context, the confirmation. It's about waiting for the market to show its hand, aligning multiple factors before committing capital. Let's look at the short-term buy strategy.
Okay.
The target is accumulating near $62.90, but only after, and this sounds technical, trap 33 resolution, which suggests a specific pattern shaking out weak hands plus confirmed rhythm acceleration and volume expansion and sustained gold price strength.
Whoa, okay, so a lot has to line up. You need the shakeout, the speed picking up, the volume confirming it, and the underlying gold price cooperating. It sounds like waiting for a very strong, confirmed burst of momentum.
That's exactly it. High probability for a quick, sharp move. Now, for the swing term buy strategy, thinking holding for maybe weeks or a few months, the entry target is around $59.20.
And the conditions for that one?
Yeah.
Still in plex.
Specific, yes. It requires rhythm development. So the initial acceleration has settled into a more established, sustainable pattern, and you need sustained buying pressure, showing that bigger players are still interested, that it's not just fizzling out.
Okay, so a more developed, steady trend for that swing trade. And then the midterm buy strategy, this is the longer view, right? Yeah. Targeting $51.30 consolidation.
Right. This is the strategic, potentially multi-year play, and the conditions tie directly back to that crucial $50, $60 pivot zone we discussed.
Okay. So this entry only becomes valid
if the stock actually revisits that $50, $60 support area, holds, and that marks the start of a new upward phase. Plus, you still need that trap 33 resolution within that time frame and rhythm re-expansion, meaning the underlying flow is picking up steam again for a longer-term move.
So that $51.30 target is really about capturing the potential start of a whole new major bull cycle, assuming that pivot holds.
Precisely. It's positioning for the big multi-year potential.
Now, the analysis layers something else on top. Elliott wave, I've heard of it, seems complex. How does it fit in here?
Yeah, Elliott wave theory. It's a way of analyzing market cycles based on recurring wave patterns, supposedly reflecting investor psychology. Think of it as trying to map the market's emotional swings onto the price chart. There are impulsive waves moving with the main trend and corrective waves moving against it.
Okay. So how does VPR use it?
It uses it as a confirmation tool, another layer of evidence to support those entry points. For instance, that short-term $62.90 entry, it aligns with what Elliott Wave calls Wave 3 underway.
And Wave 3 is?
Typically the strongest, longest part of the main trend, the power wave. So seeing that align with the VPA signals like trap 33 and rhythm expansion adds a lot of technical weight to that short-term buy idea. You're potentially getting in during the most powerful phase of the move.
Got it. And the swing term entry at $59.20.
That aligns with a wave 4 corrective phase. Wave 4 is usually a pullback or consolidation within the bigger uptrend. It shakes people out before the final push.
So buying into that wave 4 dip, if confirmed by VPAR's volume support and trap 33, is like getting a slight discount before the next leg up.
That's the idea, a strategic entry during a pause in the main trend.
And the big one, the midterm, $51.30 entry.
That aligns with analysis pointing towards a potential wave 5 extension, likely toward an $82 target. Wave 5 is the final leg of the main trend, often making new highs.
So that entry is positioning for that final, potentially significant upward push towards $82. Again, confirmed by VPAR's conditions like the pivot hold and rhythm re-expansion.
Exactly. This layering VPAR's rhythm and flow analysis, combined with a framework like Elliott Wave, really highlights the strategy's focus on needing multiple signals to align. It's not relying on just one thing. It's looking for that confluence of evidence.
It definitely sounds meticulous, like building a very strong case before making a move. Okay, let's look closer at the charts themselves. The sources mentioned circled areas on the Newmont chart, showing past consolidation and breakouts. Why is looking at those past examples helpful?
Because history often rhymes in markets, right? Seeing how the stock behaved before previous big moves, how it consolidated, how it built energy, what the breakout looked like gives you valuable clues for recognizing similar setups in the future. It's pattern recognition, essentially.
Learning from the past to anticipate the future makes sense. And it also mentions higher probability buying zones near swing or midterm lines. What are those lines likely referring to?
Usually key trend lines or important moving averages. These are levels where the price has previously found support or resistance repeatedly. Buying near these lines, especially when they align with the overall trend and VPAR signals, is considered higher probability because you're entering at a technically significant level where buyers have stepped in before.
And you mentioned multi-time frame analysis earlier. The sources stress reviewing patterns on short, swing, and midterm charts. Why look at all three?
Because context is everything. A stock might look like it's breaking out on an hourly chart, but if you zoom out to the daily or weekly, it might still be stuck in a downtrend or a bigger consolidation.
You could get faked out by a short-term move that goes against the bigger picture.
Exactly. Looking at all time frames ensures your trade aligns with the dominant trend you're actually trying to capture. It prevents you from making a decision based on just one narrow perspective.
Got it. Now back to VPAR's core ideas: rhythm expansion and volume confirmation. The analysis says all time frames show trend acceleration with clear rhythm expansion. How do we see that rhythm expanding? Is it just price moving faster?
It's partly that, but it's more about the intensity and conviction of the flow. It's becoming more directional, more pronounced. And technical indicators help confirm this visually, like Bollinger Bands widening.
Right. Bollinger Bands measure volatility.
Yes. When they spread apart significantly, it signals increasing volatility, and usually a strong trending move is underway. It visually confirms that rhythm expansion, showing the price is moving forcefully away from its average.
And volume. You keep coming back to surging volume. Why is that the ultimate confirmation?
Because volume represents participation, conviction. A price move on low volume could be anything, easily reversed. But a price move, especially a breakout, on surging volume.
Yeah.
That tells you big players, institutions are involved, they're committing serious capital. It confirms the buying momentum and makes the move much more likely to be sustainable. It's the market validating the price action with real money.
Okay. And the fact Newmont is staying above the box range center also matters.
Yes, within that consolidation box we talked about, staying above the midpoint is a sign of underlying strength. It suggests buyers are absorbing selling pressure relatively easily, making an upward resolution more likely than a breakdown.
So putting all that technical VPR perspective together, what's the immediate outlook for Newmont? Test highs or pullback?
Based purely on this analysis, the outlook is that Newmont is poised to retest upper targets. The momentum seems to be there, unless there's some kind of external shock. A surprise event, geopolitical, economic, maybe even company-specific that throws a wrench in the works.
And if that happens, where does VPA suggest it might pull back to?
Right back to that critical $50, $60 support zone. That level is consistently highlighted as the major strategic pivot, the line in the sand where significant buying should emerge if the long-term uptrend is to remain intact.
It really keeps coming back to that $50–$60 zone as the key long-term level. Okay, shifting gears slightly. It's not all about charts and numbers. Our sources also cover important company news and events, things that give you a fuller picture, like that incident at the Red Chris mine.
Right, the rescue of the 3 trapped workers, a very serious situation, obviously.
Absolutely. Thankfully, they were freed safely. But what does an event like that tell investors beyond the human story?
Well, it really puts a company's safety culture and emergency preparedness under the microscope. The fact that it ended successfully, according to the sources, highlights the effectiveness of Newmont's emergency protocols and their commitment to safety first.
Which is crucial in mining.
Hugely. Operational safety isn't just about compliance. It's core to maintaining your license to operate, employee morale, avoiding shutdowns, managing reputation. A successful outcome in a crisis like that actually reinforces the perception of competent, responsible management. It can, paradoxically, strengthen confidence in their operational capabilities.
Interesting point. And the sources also reiterate the share buyback is key news.
Yes, that $3 billion program. It's highlighted again, emphasizing its significance as a signal of strong cash flow and financial health. It's management putting money behind their belief in the company's value, a tangible return to shareholders.
And finally, the ESG report. Newmont published its 2024 sustainability report using GRI and SSB standards. Why is this increasingly important, especially for a miner?
Because ESG, environmental, social, governance factors are becoming critical for investors. It raises that key question. Financials look good, but how do you weigh these other risks and responsibilities? Especially in mining, investors want to see proactive management of environmental impact, community relations, safety, governance. A detailed report using recognized standards like GRI and SSB signals transparency and helps manage risks related to fines, protests, regulations, or loss of social license. Strong ESG can actually attract more investment and potentially improve valuation over time. It's not just soft stuff anymore. It has real financial implications.
Fair point. Okay, so on the flip side, what are the big risks investors need to keep on their radar for Newmont?
The sources flag 3 main ones. Number 1, pretty obviously, is gold price volatility. What goes up can come down. If gold prices reverse course due to changing economic conditions or sentiment, it hits Newmont's revenue directly.
Can't escape the commodity price.
Nope. Second, mine site incidents. Red Chris was a reminder. Operational risks are inherent in mining accidents, equipment failures, geological issues. These can disrupt production, cost money, and damage reputation.
And the third was macro shifts. Sounds pretty broad.
It is, but it covers crucial external factors, things like a global recession hitting demand, major changes in interest rate policies making gold less attractive, new tough regulations in places they operate, geopolitical turmoil, stuff largely outside their control that can still significantly impact the stock price and operating environment.
So lots to watch beyond the company's own performance. Okay, let's tap into the crowd. What's the buzz online? Our sources looked at community flow. What's the sentiment like on places like Reddit?
Pretty active, actually. On the Our Gold Mining subreddit, mentions of Newmont were up 35% month over month, and the sentiment was mostly positive, around 60%.
What does that tell us? Retail investors are getting interested.
It suggests that, increased discussion, positive tone. It shows Newmont is definitely on the radar for individual investors. Doesn't guarantee anything price-wise, of course, but it reflects growing optimism in that community.
And Twitter, #Newmont.
Similar story. Tweets up 28%. And you see bullish hashtags trending like #GoldRally and #SafeHaven. It reflects that broader narrative of gold being attractive in uncertain times, which benefits Newmont.
Okay, and stock twits. That's more for active traders.
Generally, yes. And the sentiment there was strongly bullish. 68% bullish versus 32% bearish, according to the sources. That suggests active traders looking at shorter time frames are largely betting on the price going up.
So across these platforms, the general vibe seems positive, even bullish. How much weight should you give this social sentiment?
It's another piece of the puzzle. It gives you a pulse on market psychology, especially among retail and active traders. It's not a primary driver like fundamentals or VPAR technicals, but when it aligns with those other factors, it can add conviction. Or if it wildly diverges, it might be a contrarian signal. It's useful context, helping synthesize the quantitative data with the qualitative mood of the market.
Right, bringing together the numbers and the narrative.
Yeah.
Okay, let's try to summarize the overall outlook then. Pulling everything together from this deep dive, the opportunities and the risks for Newmont. What are the key positives?
Well, the big opportunities highlighted are, first, that potential for continued momentum in gold prices. If the macro environment stays supportive for gold, That's a huge ongoing tailwind.
Okay.
Second, that robust share buyback program. It's a concrete action boosting shareholder value and signaling confidence. And third, their ongoing cost discipline. If they can keep managing costs effectively, they can maintain strong profitability even if gold prices moderate a bit.
So favorable market,
Yeah.
smart capital allocation, efficient operations. Sounds good.
Yeah.
But the risks haven't disappeared.
No, definitely not. The sources remind us of those persistent risks. The potential for mine site disruptions is always there in mining. Operational hiccups can happen. Second, changes in regulatory landscapes. New rules or taxes in key countries could impact costs or operations significantly. And third, that broader commodity cyclicality. Gold might be strong now, but commodity markets move in cycles. A downturn could eventually hit, regardless of Newmont's execution. Synthesizing all these factors, the quantitative, the qualitative, the risks, the sentiment is key for a well-rounded view.
Absolutely. So as we wrap up this deep dive, consider this. We've seen Newmont's strong financials, really powered by that gold surge and those strategic buybacks. And we've explored this fascinating VPR rhythm strategy. It's detailed, disciplined way of finding entry points using patterns, flow, even Elliott wave.
And we've also grounded that with the real-world operational factors, the risks, the ESG considerations, the market buzz. Hopefully, this has given you, our listener, a much clearer picture, cutting through some of that noise we talked about at the start. But here's a final thought building on all this. As you think about Newmont's strength and VPAR's precision, how might those unexpected external shocks, the true wild cards, really test even the best laid plans? And maybe more personally, how do you balance a company's commitment to safety environment against its quarterly profits when you form your own investment view? Something to mull over.